Welcome back, everyone. Today is Tuesday, November 18th, 2025. I want to kick things off with a quick look at the Precious Metals Peak Indicator Scorecard. This is essentially the framework that compares where we are today versus where we should be if gold and silver were priced at their 1980 peak equivalents, our last secular bull market. It basically gives us a simple signal if we're still early or we're approaching the top. So let's walk through it. The first two rows in the scorecard are essentially the gold and silver prices from 1980, adjusted for the growth of the M2 money supply from 1980 till today. And if we're looking at ranges that represent the blow off top of that time period in very early 1980, where basically the price peaked and moved a lot in short order, and that's why we have those ranges there. So that gold price top was a range of $7,670 to $11,050 adjusted for the M2 money supply. Currently, we are at $4,067, so we essentially should stay long. We still got a ways to go on that. Silver price, we adjust that 1980 blow off top. That final range on the blow off was $420 to $647 per ounce. And we are far off from that today. We're currently at $50.98, and we should remain long. Remember that this M2 adjustment is only going to have a higher and higher multiplier. For the most part, our M2 money supply, even the monetary base M0, just keeps increasing all the time. Any decreases or any pauses are very short, and they quickly resume, and the uptrend in that continues. So that multiplicative factor from a year from now is going to be substantially higher if we continue to get the type of money supply growth we have been getting recently. So that's the first two rows. Third row is our gold to silver ratio. And during that blow off 1980's top, we went from 16 to 1 down to 15 to 1 ratio of gold price to silver price. And currently the ratio is over 80, 80.43. So recommended we stay long. And then finally, the Dow to gold ratio, that blow off top went from 1.3 down to 1, where essentially the Dow Jones index was priced at the gold price per ounce, exactly the same price at the very peak. And we are currently at 11.33. So the recommendation is to stay long. This is our scorecard. Always a warning, do your own due diligence, seek guidance from a professional. I want to talk about something today that fundamentally drove me to invest in gold, silver miners, ETFs, and Libertads. It's known as the Cantillon effect. It's named after a famous economist, Richard Cantillon, in French, Cantillon. He was Irish-French, 18th century economist, and he was considered one of the early founders of Austrian economics. The irony behind that was I actually studied economics in college. That was my undergraduate degree. And I learned nothing about him. A lot of the focus was on Keynes and Keynesian economics. And I actually got my undergraduate degree in a very precarious time period. Essentially, I started college when we were in the dot-com bubble. Prices were absolutely taking off. People had a lot of good tech jobs out there. The unemployment was low. Those stocks were flying high. Economic times were good. And then I ended up nearing the end of my degree when we were already on the downturn and companies were laying off. The bubble had burst. And essentially, I was at a crossroads where I had to decide, did I just want to get my degree and, try to find a job, which the prospects were not very promising at the time, or did I want to continue to graduate studies? And so I set my mind on graduate studies. And in particular, I was either going to do accounting, and accounting, my mindset at the time was, Sarbanes-Oxley was driving demand for finance, for accounting. But at the same time, I was also cognizant that mathematics based degrees are always in high demand for the most part, and it's much easier to get a job with math. As I was nearing graduation and having enough credits to graduate, I started using my free electives to prepare me to apply for an accounting MBA, and at the same time also prepare me to apply to graduate school for economics. And it just happened to be on one particular semester I took a upper level econometrics class, and at the same time I took an upper level statistics class, both in the same semester. And there was just a lot of synergy between those two classes, and I was taking the classes. Things made sense to me. Like, I know a lot of people tell you, like, oh my god, econometrics, statistics, like, I'm not into that. But for me, it made sense, and I actually really enjoyed it. And I think as that semester was progressing and I was learning in those two classes, I kind of said, like, I'm going to apply to both, but this is the one I think I want to do. And I liked it so much. Funny story, me being crazy back then. For both of those finals, they were on two separate days, but for both of them, I remember the econometrics class. I was so confident in it. It was just, it all made sense to me. I drank 6 beers in the couple of hours leading up to that exam. So I went to that exam pretty happy, didn't have much of a hard time. I got an A in that class. And then the statistics class, it was essentially covers all the main topics of statistics that prepare you for graduate studies. And that one, I also had some Mike's Hard. I had like 3 or 4 Mike's Hard Lemonades leading up to that day, a couple of hours leading up to that exam. That one was a little harder, being 3 sheets to the wind, but I managed and I still got an A. And I kind of knew, like, this is what I wanted to do, and I did go to grad school for economics. So again, to emphasize the irony further, not only do I have an undergraduate degree in economics, I have a graduate degree in economics. And in all that time, I did not learn about Richard Cantillon at all. I did not learn about Richard Cantillon until I started doing my research for investing when the great financial crisis hit and they turned that money printer on, and I started studying Austrian economics, their school of thought. I discovered Richard Cantillon and the Cantillon effect. And basically, the crux of what he talks about of the Cantillon effect is that when there's new money gets printed, it does not spread evenly throughout the economy. It spreads unevenly. And so it creates winners and losers because why? Not everybody gets to touch that newly printed money at the same time. Those that touch it first, and we're going to talk about who gets to touch that new money first, they benefit before then the overall prices rise due to all that new money flooding the economy. Articulating a little further how it works, the newly printed money, it enters through banks and corporations. Those are really the first institutions, the first folks to touch the newly printed money. They get to spend it first, and they get to spend it and invest it before anybody else gets to see it or becomes cognizant of its existence, of it flooding the marketplace. So they're buying the assets first, they're buying up everything first, and the working class, the middle class, the poor, they're seeing their wages or fixed incomes rise as last in the order. So basically, all the benefit goes to the early receivers of this newly printed money, and those that see the money last, they suffer. Let's look at an example in a micro economy. We got newly fresh printed money. It is the banker class that receives this money. They touch it first. So in the example here, they go out and they buy land, and they're buying it at what I call yesterday's prices, meaning they have this new money, but the marketplace hasn't realized there's this new money and it's floating around in that particular asset class, land and housing. So the banker class, they quickly acquire homes and businesses before that actual price inflation hits. Then they started buying, the prices rise because they've gone on this buying spree, and they are now the owners of these appreciating assets. The working class, they have to pay higher rents and prices, and then finally, when the money finally trickles through the whole economy, the last thing to finally go up, it's the wages. They initially stay flat, they'll eventually rise, but it's the last thing to rise. To summarize what's happening here, basically, you have a marketplace that hasn't yet repriced for the new money that's flooded, that's been printed and it's starting to flood. So the early receivers of this new money, they get to buy everything at what I call yesterday's prices, and everyone else gets stuck paying tomorrow's prices once that money has already flooded and appreciated asset prices. If we wanted to state that a little more explicitly, it's as if the rich are robbing from the poor. A lot of techs out there call inflation a stealth tax. That's another way of putting it. And as I mentioned earlier, I did not learn about the Cantillon effect until after grad school. So in 2008, great financial crisis, when the Fed started printing a whole lot of money and all of this started coming to my attention, this was a great resource. This is Mises.org, named after the famous economist Ludwig von Mises. And there's a wealth of free information in here. If you go to the library, there's a whole lot of books. Like, they're available for purchase, but they are also available for free as PDFs, and you could actually read them. I highly recommend this. This was very good stuff for me. If you were not previously aware of the Cantillon effect, I think now you'll have a greater appreciation for just how acutely messed up inflation truly is. And it'll probably give you more motivation to invest more in this sector, protect your wealth from the Cantillon effect, buy yourself some more Libertads. And speaking of Libertads, here is our showcase piece for today. We're going to go over the 2017 1-ounce silver Libertad. Let's kick off 2017 by looking at the mintages. If you remember from last time, the 2016 was as just over 1.4 million mintage, and 2017 vastly different, much less mintage, down to 636,000. Just about middle of the road in terms of scarcity. I'll kick off the discussion on the population reports by first looking at PCGS, because I just think whatever data is here for 2017 is not credible. It just doesn't align. Seems like those that are the admins for putting this information here on their website, it just doesn't sync up right. It's saying that there was only 246 total graded 2017 1-ounce MS silvers. Highly suspect given, the total graded numbers for 2016, for 2018, for 2019. That does not make sense. Something seems to be off there. So we're going to focus all our effort here on the NGC side. NGC has 2,411 total graded for the 2017 top pop MS70 with 1,483. Let's take a look now at our eBay sold comps for the 2017 Silver Libertad 1-ounce. You turn on your sold listings filter, sort by ended recently. Interesting, one of the first results on the sold comps on November 17th is a PCGS graded MS70 first strike, went for $182.50. If you look back on my channel, one of my first videos talked about first strikes from PCGS, and that, to me, that's a deceiving term to be using on a slab. It's almost suggestive of it was one of the first 2017s to be struck at the mint and then was slabbed. But if you actually Google the definition, that's not what it is at all. It basically has to do with the timing from when they were released and when they arrived to PCGS for grading. So I've seen sellers who have tried to deceive prospective buyers with the nomenclature of that first strike, not really defining it for what it really is. But that's a whole story of itself. You should check that video out if you want more detail on that. We got some raw ones down here on November 16th, $61.77. November 15th, $80. Also on the 15th, $65. Buy it now. And there was also a bidding auction for $65. same day $60.77. So that gives you a pretty good idea of what these have been going for over the last couple days.